Most people will never build real wealth from investing. Not because the market is unfair, not because they started too late, not because they did not have enough capital, because they never had a framework. Welcome to the ProfitByFriday.com podcast, where we replace guessing with process, emotion with discipline, and noise with one clear idea every single week. Now, let us get into it. In 1962, a 24-year-old named Phil Knight wrote a paper at Stanford Business School. The title was simple: Can Japanese sports shoes do to German sports shoes what Japanese cameras did to German cameras? It was not a business plan, it was a hypothesis, but Knight believed it enough to act on it. After graduation, he flew to Japan. He walked into the offices of a shoe company called Onitsuka Tiger, and he pitched himself as the representative of an American distributor. He had no company, he had no distributor. He made the name up on the spot: Blue Ribbon Sports of Portland, Oregon. The executives bought it. Knight flew home with sample shoes and no real plan for selling them. So, he loaded the shoes into the trunk of his green Plymouth Valiant and drove to track meets across the Pacific Northwest. He sold shoes from the trunk of his car. His starting capital was $1,200, split with his old track coach, Bill Bowerman. That was the entire operation. In their first year, Blue Ribbon Sports sold 1,300 pairs of shoes and generated $8,000 in revenue. Sales doubled every single year for the next 5 years, and Knight still could not afford to pay himself a salary. He worked nights as an accountant. He taught on weekends. Every dollar went back into the business. Most investors hear this story and walk away inspired by the struggle. That is the wrong lesson. What Knight was building, without fully knowing it, was a business on 3 structural principles that the best investors in the world now spend entire careers trying to find. The first principle is this: the brand is the business. Nike does not make shoes. It never really did. Onitsuka Tiger made the shoes. Then factories across Asia made the shoes. Nike designed them. Nike marketed them. Nike owned the desire for them. There are 2 kinds of companies: those that make something and those that own the reason people want something. Companies that make things compete on cost and capacity. Their margins are always under pressure. A factory in one country can always be replaced by a cheaper factory in another. Companies that own desire compete on something that cannot be replicated. Here is the investor test. If a company raised its prices by 20%, would its customers stay or leave? If they would stay, you are looking at genuine business grip. If they would leave, you are looking at a commodity. The second principle is asset-light scale. Nike contracts with over 700 independent manufacturers across more than 40 countries. It owns none of them. When revenue grows, costs do not grow at the same rate. The margin expands as the business scales. Compare that to a business that owns its factories. Every new unit of revenue requires a proportional investment in physical infrastructure. Margins stay flat or compress. The third principle is distribution leverage. Knight did not pay for celebrity when he signed Steve Prefontaine, John McEnroe, and Michael Jordan. He paid for distribution into communities that already trusted those athletes completely. Every person who admired Michael Jordan became a potential customer the moment Jordan laced up a pair of Nike shoes. The Jordan brand eventually generated over $5 billion per year in revenue. Today, every company pays influencers and creators to do exactly what Knight discovered in 1963. Reach people through someone they already trust. Brand grip, asset-light scale, distribution leverage. Phil Knight built all 3 before anyone knew what to call them. And these 3 properties do not only exist in Nike, they exist in public companies trading right now. Some of them mid-cap, some of them still small enough that the market has not fully priced them in. The investor who learns to identify these properties early is not guessing. They are reading the same signals that built the most valuable brands in history. Visit ProfitByFriday.com today. Subscribe free to the Friday Flash, where you will receive one stock fully evaluated through the Clear framework every Friday, so that you know everything about the company before you decide to invest. No noise, no hype, just the analysis that matters. We trade for cash flow. We invest boring to build legacy. See you in the next episode. Bye for now.